So the first question you have to ask yourself is, why should I give? Why? You give because it feels good. Research has shown that when we give, you get dopamine and other positive chemicals are released in your body. Don't just give when you die. Give while you're alive so you can enjoy the benefit of it. So giving it'll be good for you. As we already talked about, generosity and giving actually leads to prosperity of your soul. Like, you're going to feel amazing in your soul, in your spirit, and it leads to building wealth. When we give, it's like we're planting a seed in the ground, and then that seed bears fruit and it grows into a tree, and the tree bears fruit. And so the seed, which was your gift that you put into the ground, multiplies into all of this fruit that comes back to bless you. You're listening to Legacy Maker Podcast with Kristina Hess. Clear guidance for protecting your wealth, empowering your family, and creating a lasting legacy of generational impact. Legacy Maker, let's go. How to create a charitable legacy. Giving to charity and other charitable organizations can really make your legacy meaningful and have purpose. In this episode, I'm going to talk about 4 ways to give charitably. Hey everyone, it's Kristina Hess, the host of Legacy Maker Podcast, coming at you again with one of my favorite topics, which is charitable giving. I love talking about charitable giving because the truth is, generosity is the key to a good life. The proverb says that a generous soul shall prosper. Generosity is not only the key to a good life, generosity is the key to building wealth. Generosity is a key to prosperity of soul, mind, body, and spirit. Because the truth is, when we give, it's given back to us. Pressed down, shaken together. So the first question you have to ask yourself is, why should I give? Why should I give? You give because it feels good, right? Research has shown that when we give, you get dopamine and other positive chemicals are released in your body. Like, don't just give when you die. Give while you're alive so you can enjoy the benefit of it. So giving it'll be good for you. Giving is good for you. As we already talked about, generosity and giving actually leads to prosperity of your soul. Like, you're going to feel amazing in your soul, in your spirit, and it leads to building wealth. People and groups who give generously, whether they tithe to local religious organization like their synagogue or their church, people groups who tithe are more prosperous than those who don't. Why? Why are they more prosperous? Because there's a spiritual law that you give and it shall be given back to you. When we give, it's like we're planting a seed in the ground, and then that seed bears fruit and it grows into a tree, and the tree bears fruit. And so the seed, which was your gift that you put into the ground, multiplies into all of this fruit that comes back to bless you. So giving can actually be a way to receive. Ironically, it's when we give, we also receive. Not that that should be your only motivation, but the reality is you're going to be blessed by giving. So that's a really good reason to give. And then the next question is, okay, so you're motivated to give. You want to give because it feels good. It's going to be good for you. And you want to follow the spiritual principle and build wealth. Giving is prosperous. What should you give? So this is a really great question, and we're going to talk about 4 different ways to give, which is the third question. How should you give? And what you give depends on how you give. What the asset is or how you want to give is really going to define the strategy that's going to make the most sense for you. So a lot of times it's a good idea to give highly appreciated assets to charity. Why? Because the charities don't pay any tax. So if you, for example, have a rental property and maybe you're tired of being a landlord, then rental property would be a really great tool to give. But you don't have to give 100% of your property to get the benefit. And I'm going to tell you all about that. Maybe you just want to give cash and you get the full income tax charitable deduction because you're just giving cash. But maybe you don't want to give it to charity this year and you want to find a way to give it efficiently. Well, that's our first strategy that we're going to talk about. So I'm going to talk about 4 strategies. The first one is the donor advised fund. The second one is a private charitable foundation. And the third one and the fourth one are charitable trusts. So I'm going to talk about two different types of charitable trusts, the charitable remainder trust and the charitable lead trust. So those are four key strategies. So hopefully you're going to learn some good things today. All right, you ready? And here's my disclaimer. Even though I am an estate planning attorney and I've been an attorney for over 25 years, I am not your attorney unless I am and you've signed a written attorney-client agreement and you've paid me a fee. But otherwise, everyone else, this video and this podcast is for informational and educational purposes only, and it is not intended to be legal advice. All right, disclaimer out of the way. Let's dive in. All right, the first strategy, the donor advised fund. The donor advised fund gets the win on simplicity. The donor advised fund is a simple way to give. It's got low cost or no cost. It's easy to administer, and you just give to the DAF. Donor advised fund is also commonly referred to by the acronym, which is DAF, which is DAF. So Schwab, Fidelity, any of the big brokerage houses, they have donor advised funds within their institutions. So let's say you want to maximize your charitable contribution and you want to double up in 1 year to get the maximum income tax charitable deduction, you can give it to a donor advised fund, and then you get the immediate income tax charitable deduction in the year of the gift. So it's easy, it's simple. And then in your donor advised fund, you'll have a board or advisors who will then designate where the funds will go to charity. But they don't have to go to charity in the year of giving. They can be given to charity later. Right now in the United States, there are billions and billions of dollars in donor advised funds. They have become so popular over the last few years because of these reasons. They're easy to administer, you get the immediate income tax charitable deduction, and you can designate where they go later. What are some of the downsides of DAFs? You're subject to the rules of the custodian that holds the DAF. So, for example, if you wanted to give to an individual or to other maybe private foundations that are not recognized public charities, that might be restricted. So you don't have as much flexibility in your charitable giving with the DAFs. That's one of the downside. The pros I already talked about. The upside is it's low cost, it's easy to administer. You send the money there and you get the immediate deduction. All right, so simple. But not a lot of control on the back end. And then if you were to pass away, you can designate successor advisors who could say where the funds in your donor advised fund go. All right. Second strategy is the charitable foundation. Now, where the DAF lacks in control, the charitable foundation gives you a lot more control. But where the DAF was easy to administer, the charitable foundation is not necessarily. There's different types of charitable foundations. Oftentimes, a private foundation will be called a private family foundation because maybe a family is setting up a foundation. So I'll give you an example. We had a client and they wanted to set up a private charitable foundation. The husband had passed away and they wanted to provide scholarships to students that were worthy, good students, wanted scholarship fund in honor of his memory at the institutions that he attended. So I believe he had attended a private Catholic high school and university, and so they wanted to benefit deserving students who were academically talented and qualified and provide ongoing grants to assist those students. So that's an example, and the wife and the family members can run the foundation. If they do a lot of the work themselves, you can keep the cost down, but otherwise you do need to file tax returns, which are part of the public domain, and so you'll need a tax accountant and an attorney to help you set it up, and there is ongoing compliance and restrictions. There's private foundation rules that you have to adhere to. So it is more complex and there is a higher degree of complexity, also a higher degree of cost of administration. But you can put a lot of money into the charitable foundation, and typically with a private foundation, you would give grants or give out money of 5% of the balance per year. So every year you could give grants to families or things like that. You could also do a public foundation. So with a public foundation, 1/3 of the resources are solicited from the public. So this would be when you would be doing fundraising or getting the word out about your foundation because you want other people to be able to contribute to your foundation. And if more of a third of the money is coming from the public and from fundraising activities, then you have a public foundation. There's also operating versus non-operating foundations. And that kind of means what it says. Like an operating foundation could be like a school, or you're operating the actual charity, versus a non-operating foundation is more of a grant-giving organization. So this is a high level of charitable foundations. The great thing about charitable foundations is you can put the money in, get the tax deduction, and then your family members and other people, if you want people involved generationally in family governance and in running the charity, and you want to leave a legacy through your family name, and you want the next generation and successive generations to be involved in the family legacy, then the foundation is a wonderful way to go. Number 3, let's talk now about the charitable trust. Charitable trust. So the first charitable trust is a great tool if you want a way out of capital gains tax. So let's say, for example, you had a highly appreciated real estate property, right? So you have a rental property. I'll give you an example. We had a case study where mom bought a rental property in San Diego for around $100,000. Fast forward 30 years, this property is near the University of California. It's now worth $1 million. So mom has $900,000 of capital gain. If mom sold that property, she would have to pay almost 38% capital gains tax, because the long-term federal capital gains tax rate is 20%, but then you have the Medicare surtax, which is 3.8%. And then on top of that, California, if you happen to live in California, taxes capital gain like ordinary income. So a $900,000 gain would be in the highest tax bracket, which is over 13% for California. If you happen to live in a more favorable state that doesn't have such high capital gains tax other than California, congratulations. But still, you're looking at over 20% federal capital gains tax. It could be 25 to 28, depending on the state where you reside. That's a big tax bill. In this situation, $900,000 of gain, 38%, over $300 some thousand dollars in capital gains tax. That's where the charitable remainder trust can be a great strategy. So let me show you how this works. So with the charitable remainder trust, mom takes her house in San Diego. She transfers it to the charitable remainder trust. You cannot have a prearranged sale. Okay, so rule number 1, no prearranged sale. So don't list it on the market, don't have a real estate broker, don't have a plan for selling it before you put it into the charitable trust. The other big thing is you can't have a mortgage on the property. If you did have a mortgage on the property, then you could get a bridge loan and get it paid off before you enter into this strategy. Okay, so free and clear property, no prearranged sale, mom transfer it to a charitable remainder trust, and then the trustee then sells the property, zero capital gain. Zero capital gain. And then mom and then her daughter in this particular situation receive income from the trust for life. And mom and daughter are the trustee of the charitable trust. So they get to manage it, and then their wealth advisor is going to invest the proceeds from the sale, and then they get a payment for life. Now, the payment has to be anywhere between 5 and 50%. So if it's a lifetime payout, you can't pay yourself 50% because you would run out of money in like 2 years, right? So at the time you set up the trust, once the life ends, the remainder goes to charity. So at the time you set it up as an actuarial calculation, the charity needs to get 10% of the remainder. So $1 million asset, 10% would be $100,000, would need to be projected to go to charity. Whether the charity actually gets $100,000, there's no guarantees. But the percentage that you take out over the life expectancy based on actuarial tables cannot exhaust the trust more than 10% remainder. In this particular situation, there was, call it a 45-year life expectancy, so mom and daughter were able to receive 6.5% from the trust for life. So they get income from the trust in the amount of $65,000 per year for mom's life, and then when mom dies, for daughter's life, $65,000. Now they do pay income tax on the $65,000. However, not only was there zero capital gain on the sale of the house, they also get an income tax charitable deduction for the value of the remainder interest. So if they can't use it all in year one, that income tax charitable deduction can carry forward for 5 years. So it's going to save them on their income tax for the next 5 to 6 years, depending on their adjusted gross income. To maximize the strategy even more, instead of putting 100% of the house into the charitable trust, you could say put 50% in. 50% in, leave 50% out. They still sell it. The 50% out of the trust comes directly to the owners. There will be capital gains tax on the 50% that didn't go into the trust. But remember that income tax charitable deduction could potentially help them save taxes on the gain there as well. So it's really great to run different numbers and different scenarios and see how you can maximize your income tax charitable deduction and benefit charity on the back end. This is a really great way to eliminate capital gains tax completely. You are taxed on the income and give yourself an income stream for life and get a charitable income tax deduction. This is a prime example of the two different types of legal systems. There is the tax code for the informed and the tax code for the uninformed. This is what Justice Holmes famously said many years ago, that we have two tax codes for the informed and the uninformed, because an uninformed person would just sell the property and have over $300,000 in capital gains tax. The informed person, who happens to also have some charitable intent, would sell the property and get an income tax charitable deduction and completely bypass capital gains. You can use this with real estate. You can use the charitable remainder trust with highly appreciated stock. You can use it with business interests. Again, you just need to avoid a prearranged sale. All right, so that is strategy number 3, charitable remainder trust. And now for our last strategy of the day, the charitable lead trust. The charitable lead trust is the opposite of the remainder trust. So with the remainder trust, the donor gets the income stream for 20 years or their lifetime. With the lead trust, and then the remainder goes to charity. With the lead trust, it's the opposite. With the lead trust, the charity gets the payout from the trust for a term of years. A charity doesn't have a lifetime, so it's not a lifetime. It's a term of years. So typically, the term of years will be around 20 years, but it could be 10 years, it could be 15 years. You can define how long the charitable term is. And then, so they're the lead beneficiary. That's why it's called the charitable lead trust. The charity gets the payments first. So when would you use a charitable lead trust? You use a charitable lead trust in a high income year. Let's say you sold a business, or let's say you got a huge bonus, or the company did amazing that year and you had a really high income year and you're facing a really huge tax bill. Enter the charitable lead trust. This could be a great strategy. Now, charitable lead trusts do better in a low income rate environment. So when interest rates are really low, these trusts are amazing. But nevertheless, it's for somebody who has a high income year and they want a big charitable income tax deduction. This is a great trust for them. And they're giving to charity. So let's say, for example, someone had $1 million year. They're like, wow, this is great. I had $1 million year. Fantastic. But Uncle Sam's going to take half or more of my earnings this year. So what can I do? Let's say you set up a charitable lead trust and you put $500,000 of your $1 million earnings into a charitable lead trust. You'd probably get an income tax deduction of about $250,000, depending on the interest rates at the time. And then you can pay a charity a minimum amount. Oftentimes we'll set it up so the charity gets, say for 20 years, you're going to pay charity from your 500,000. So maybe for year 1 through 19, you're giving the charity a small amount, $1,000 a year, $5,000 a year. You're giving them a small amount. And then in year 20, they're going to get the balloon payment based on the interest rate the IRS says the federal interest rate on their money for those 20 years. So they're going to get $500,000+ in year 20. But let's say the interest rate is 4%. So you're paying the charity 4% on their money. Or according to the IRS estimated income tax table, we're estimating that the money should grow at that interest rate, 4%. But let's say you have an amazing financial advisor and the markets are doing well, and let's say the trust actually grows at 10% per year. You're only paying the charity 4% on their money for those 20 years, and then the trust is growing at 10%. There's going to be a pretty big exponential remainder interest. So that either is going to come back to you multiplied, pressed down, shaken together, running over, or you can send it to a legacy trust for your children and completely move that asset out of your taxable estate. So if that $500,000 that goes to charity plus 4% interest over 20 years, and then it grows at 10%. So now let's say you've got, this is not going to be good math. I didn't run the numbers, so apologies for that. But let's say it's $2 million. The remainder value is $2 million. That is either going to come back to you or it's going to go to a legacy trust for your children out of your taxable estate, completely tax-free. So you got an income tax charitable deduction. You give to charity, you get to feel good, generosity, and you get the multiplier effect of giving and putting a seed into the ground. If the trust doesn't grow at greater than 4% per year, then we've got bigger problems in the world. And there's no remainder interest, but you still got the charitable income tax deduction, and there's really no downside to you. So this is a win-win-win. You get to get an income tax charitable deduction, give to charity for a period of years, and hopefully the assets will grow and create a legacy that either comes back to you or can go out to a legacy trust for your children. Charitable lead trust for high income earners. It's a fantastic strategy. There's other ways we can use this trust as well. I'm just giving you one hypothetical example, and hopefully that will give you some food for thought. All right, so leaving a charitable legacy, why should you do it? Because generosity of soul, your soul prospers when you give. It comes back to you. You build wealth by giving. You get to feel good. Generosity is just an amazing thing. What should you give? Highly appreciated assets, if you can. Stock, bonds, real estate, crypto. Give your highly appreciated assets. And then how should you give? That depends on you. Which of the 4 strategies is going to work best for you? Donor advised fund, private charitable foundation if you want to leave a family legacy, charitable lead trust, charitable remainder trust. And did you know that you can actually have a private charitable foundation, and that can actually be the charity in your charitable remainder trust or your charitable lead trust? So you can pair your private family foundation with the charitable remainder trust and the charitable lead trust. The only downside is you get a lesser income tax charitable deduction, 20% versus 30%, so you don't get as much income tax deduction, but you're benefiting your own charity and your own family foundation, which is amazing, I think. All right, so which strategy is right for you? It really depends. Do you want something really easy? Just give it to the donor advised fund. Do you want to build a legacy and have family involvement and family governance? Then the private foundation. Did you have a high income year? The lead trust. Or do you have a highly appreciated asset that you would love to sell, but you don't want to pay high capital gains tax and you have charitable intent? And as a bonus, something that a lot of people will do with the charitable remainder trust is, because now you've got this income stream for life, say $65,000 or whatever it is, they'll take a piece of that and they'll buy a life insurance policy on their life, because then they're replacing the asset for the kids and the grandkids through the life insurance policy. So you can combine these strategies with life insurance as well, and it's really powerful. All right, everyone, legacy maker, let's go. This is a great way to build a legacy, to feel good, have a prosperous soul, and make a difference in the world to different organizations that you love, or your local religious organization, your synagogue or your church. You're building the kingdom of God, or maybe you want to save the earth, or maybe you want to help build wells in Africa, or eliminate different diseases. There's so much good that your money can do in the world, so make your legacy today. Thanks for joining me today. When you're ready to take the next step, connect with us at legacymakerpodcast.com. And until next time, stay wise, stay intentional, stay a legacy maker.